Welcome back. Today on the Bite-Sized Brief, we're going deep on PACCAR Inc., ticker PCAR. And folks, this one's a real head-scratcher. We're looking at a company that's facing a pretty tough market, yet somehow it's pulling in near-record profits. It feels like it shouldn't be possible, but the numbers don't lie. So let's unpack this paradox together.
Yeah, that's the big question, isn't it? How on earth do you pull off record profits when the very market you depend on is hitting the brakes? On the surface, it just doesn't add up. To really get what's going on, we have to look at two key numbers that seem to tell completely opposite stories.
Okay, so first up, let's talk revenue. For 2025, PACCAR brought in a whopping $28.4 billion. That is a huge number. But, and this is a big but, that's actually down 15.5% from the year before. So right away we see the problem. The market for trucks is soft. They're just not selling as many. Pretty straightforward, you'd think.
Right. But hold on, because this is where things get weird. In that exact same year, with falling sales, their profit, their adjusted net income, was $2.64 billion. Now, to put that into perspective for you, that is the fourth highest profit in the company's entire 121-year history. Let that sink in. Revenue is down double digits, but profits are hitting near all-time highs. So what is going on here? Well, to solve this mystery, we've got to look under the hood of their business model. It turns out PACCAR's real profit engine isn't what you think it is.
So if you just look at where the money comes from, the revenue, it all looks pretty standard. 68%, the vast majority, comes from selling trucks. Makes sense, right? They're a truck company. The other slices, parts and financial services, almost look like side gigs. But remember, revenue is only one part of the equation.
Now watch this. This is the big reveal. When we stop looking at revenue and start looking at profit, the whole thing flips upside down. Suddenly, those side gigs, parts and financial services, are responsible for an incredible 71% of the profits. And selling the actual trucks, that only brings in 29%. That right there, that's the secret sauce. That's how they're doing it. You know, there's a name for this business model, and you've definitely experienced it yourself. It's called the inkjet printer model. Think about it. You buy a printer for a decent price, maybe even on sale, but then you have to keep buying their expensive ink cartridges forever. That's where they really make their money. Well, PACCAR does the exact same thing. The truck is the printer, and the high-margin replacement parts are the ink. I love this quote from HD and Research because I think it sums it up perfectly. They said, selling a truck is a one-time date, but selling parts is a long-term marriage. And that's exactly it. That marriage provides this incredibly stable, high-profit revenue stream that just keeps on giving, year after year, good times and bad. It's their all-weather profit engine. Okay, so we've cracked the code on their profits, but the story's getting a little more complicated now. There's some new factors at play, some that are a huge help, and frankly, some that are pretty concerning.
Let's start with the good news. There's this trade policy called the Section 232 tariff. Now, this used to be a pain for PACCAR, adding extra costs, but the tables have completely turned. Because they build so many of their trucks right here in North America, this policy now actually helps them by putting their foreign competitors at a disadvantage. So what used to be a problem, a headwind, is now a major tailwind pushing their profits forward.
Okay, but now for the first major red flag, insider selling. Look at these numbers from just the past 90 days. Top execs have sold off more than $16.6 million worth of their own stock. The CEO and EVP, we're talking about the people who know the company best. Now look, there can be a million personal reasons to sell stock, but when you see a cluster of selling this big, you have to ask the question, what did they see coming that we don't?
And that brings us to the second warning sign, which this quote really captures. It says, check the fuel gauge. That fuel gauge is PACCAR's order backlog, the list of customers already lined up to buy a truck. And that backlog is shrinking. It's a pretty simple and frankly scary equation. When that backlog gets too low, the factories have nothing to build. And quiet factories don't make any money.
So, where does all of this leave us? Well, it sets up a classic Wall Street showdown, the bull case versus the bear case. Two totally different visions for what happens next for PACCAR in 2026. Let's break it down. The bulls, the optimists, they're betting on a comeback in the truck market, and they see that tariff advantage as pure fuel for the fire. They're also looking at PACCAR's investments in new tech like EV and autonomous trucks and saying this is the future. But the bears see a different story. They're looking at that shrinking order book and all that insider selling, and they are shouting warning. They're worried a big cyclical downturn is right around the corner.
Now, the bull case isn't just wishful thinking. It's built on a specific timeline of events. First up, in the second quarter of 2026, is the commercial launch of their driverless trucks with Aurora. That's a huge milestone. Then, later in the year, they're expecting a huge rush of orders, a pre-buy cycle. Why? Because new EPA rules are set to kick in January 2027, which will tack on about 10 grand to the price of a new truck. So naturally, a lot of companies will want to buy before that happens.
But the bears have their own data, and it's pretty compelling. Just look at this chart. This is their earnings per share, or EPS, which is a really core measure of profitability. And you don't have to be a Wall Street analyst to see the trend here. It's been heading down, quarter after quarter, all through 2025. For the bears, this isn't a prediction. It's proof that the slowdown is already happening.
So, bull case, bear case, who's right? Well, instead of guessing, here are the exact things you need to watch to see how this story plays out for yourself.
Think of this as your personal PACCAR dashboard. First, keep an eye on their Q1 2026 gross margin. Did they hit their target of 12.5 to 13%? That'll tell us if that tariff tailwind is real. Second, watch the parts revenue. Is it still growing in that 4 to 8% range? We need to know that profit engine is still humming. Third, truck orders. Do they start to pick back up? And finally, any news on the Aurora partnership? Does that driverless launch actually happen on time? The answers here will basically write the next chapter for PACCAR.
So that's a big question we're left with. Is PACCAR this incredibly resilient industrial powerhouse that's found a way to thrive no matter what? Or is it a classic cyclical company that just enjoyed a good run and is now staring down a slowdown? Honestly, the signals are pointing both ways. But one thing is for sure. The next 2 quarters are going to be absolutely crucial. We're going to find out the answer to this profit paradox very, very soon. That wraps up today's deep dive on PACCAR Inc. For a sharper, more candid discussion, join us on the full audio podcast. Drop your questions and takes in the comments. We read everyone.